What's up, guys? It is Sam here, and I wanted to talk about my portfolio changes for this past week. Today is July 20th. I wanted to talk about the positions that I opened, how I lost $50 for the week. And lastly, I just wanted to touch on two more things. What got me started to actually take action, and how the why I use a cost basis for the dividend growth rate on stocks. And I'll get more details of all this. But if this is your first time here, my name's Sam. What's up? If you're returning, it's good to freaking see you. Let's get started with what got me to take action. And I was thinking about this, like, why did it take so many years? So I was in grad school, and that's when I was like, I literally went to grad school, got my CFA, got the CMT level 1, CAIA level 1, and all of these other things with the sole purpose of starting a hedge fund. And I never put money towards any trading or testing any theories that I had in terms of anomalies or price action in the market to see if I could take what I had up here and use that to make money in the market. Now, between grad school, right, in 2011 when I finished up, and today, 2019, I've changed my lifestyle and shifted to allow myself to save 65% of my earned income through my job. And that's not, I'm not trying to say that in a way to brag by any stretch of the imagination, but going through that motion of saving that money and knowing that even if I were to lose this $4,500, yes, that sucks. Yes, that's a lot of money. Yes, that's not what I want to fucking do. But at the same time, I save 65% of what I make. It goes into savings and investments. So I have a long time horizon. I'm 34. I have a long time horizon. So I would rather take those risks today than in the future. But mentally and psychologically, what that did is give me a cushion so that I wasn't always going out and wanting to buy shit that I didn't need, that didn't bring me lasting long-term fulfillment in my life. And I shifted that focus to something that brings me more value in the future. The immediate rush you get from purchasing something novel, right, like a GoPro or anything, is from a psychological standpoint, there's a value that is derived from when there's a purchase, but then also having this having access to this in the future. But when you go through and look at the net present value of that value, the transaction value, because sometimes people get value or a high out of actually purchasing things, but then there's also a net present value of the value that you get by owning something like this and potentially using it in the future. And when I look at the net present value of that versus, say, taking $300 or whatever, I don't know how much this cost, actually was a gift, but whatever that is, and investing it in something that is going to generate income for me, the value in that is just tremendous from two fronts. First of all, the income or like the monetary economic benefit that I receive is just tremendous versus actually putting money out there on a depreciating thing versus putting money out there on something that's going to more than likely appreciate. So there's that right there, because over time, the value of this is just going to become less and less from the value of me just owning it and having the capacity to be able to use it. That value is just going to diminish over time. But taking the money that you would put into something like this and putting it into an appreciating asset And that is going to be increasing over time. So the differential between those two is tremendous. Now, the other portion that is not, is really tremendous is and anybody who's watching this who's probably over the age of 30 sees that the real value in the vast majority of things in life is not the short-term monetary gain or economic gain from something. It is the value that is created through taking action in your life. When you take action on your life towards whatever it is that you're trying to achieve, whatever it is that makes you happy, whatever it is that fulfills you in life, and you take deliberate action every single day to go in that direction, that process creates value and confidence and is very tremendously rewarding versus this. So the value, right, of the transaction value of purchasing something plus the net present value of owning something like that in the future brought back to the present versus the value of taking that and investing that and having some type of return in the future, whether a dividend or just buying some index funds, as well as the action of taking the time to figure out how to invest and what to put it into, though the value on that is just staggeringly different. And that is what allowed me to actually get started with, investing in, some people don't want to call it investing. That is what allowed me to get started trading options. So and that was 2011 when I graduated, so this is 2019. So 8 years later is when I actually got started on this. Now, I wanted to touch next on what actually happened this week. So if you want to see specifically what happened with the Netflix position that I had where I lost around $450 this week, $450 in that trade, you can go back on the channel. When you go back to the channel, just press that subscribe button and you'll be able to watch my videos in the future or share this video with somebody. So that trade specifically, I'm not going to talk about tremendously on this other than I lost, I think it was $460 something on that. Some of the other positions gained. So my net loss for this week ending on 7/19 was $47.26. Not bad. Did not meet my profit objective this week for the first time in 7 weeks. So hopefully we can get back on track for next week and continue moving forward. This is the first week out of 7 weeks where I've not met my profit objective. So what is my profit objective? To make enough money to be able to purchase 1 share of Tesla stock every single week, plus a margin of error. And then every 7th week-ish, roughly, I will, instead of purchasing a share of Tesla stock, I will purchase something else. So this past week was week number 7, and what I ended up purchasing was Ford, and that leads me right into the cost basis for dividends. So I bought 22 shares of Ford for around $230, and the primary reason I did that is because their dividend yield was 7.84%. So the dividend yield is going to fluctuate based upon the price of the underlying. So if somebody pays $1, right, they pay 25 cents in quarterly dividends for $1 for the year, and they're trading at $10 a share, there's a $10 dividend yield, or 10%, I'm sorry, dividend yield. Now, if you purchase that, you're able to lock in that dividend yield in perpetuity, holding everything ceteris paribus. And what companies tend to do, and if anybody's interested, they can let me know down below in the comments. I can go into the details of how companies actually go through and calculate what they're going to pay out in their dividends. Super nerdy shit, but if anybody's interested, let me know down below in the comments and I can do a video on that. But companies tend to increase their dividends over time. And if you just take a 1.5% growth rate in their dividend, right, or maybe like a 3% growth rate 1 year, or 3.5% 1 year, and no growth rate in the next year, and then 3%, and for 10 years, you have about a 9.1% dividend yield on my cost basis. That's tremendous. I'll take a 9% return on my money all day. Like all day. Like why the fuck wouldn't you do that? So that is why I purchased Ford, because my cost basis is going to stay the same, and as time goes on, right, those dividends are going to increase, so that in 10 years they'll be roughly 91 cents per share, and I bought it for about $10 per share. So my cost basis is 9%. Or 9.1%. That's tremendous dividend yield, and that does not factor in any type of appreciation in the stock price. So between now and 10 years from now, if the price goes from $10 a share to $15 a share, that's just capital gains. That's on top of what I'm already doing, and I might add to this position over time, but first I want to continue to diversify the portfolio. So every 7th week or so, purchase something else until at least around probably a portfolio of 20 to 30 holdings. Right now I'm just holding Tesla and Ford. So I want to have a more diversified portfolio. If you look at the literature, having something that's around 30 positions, you can kind of get the maximum amount of benefit associated with diversification with the minimum amount of holdings in your portfolio. So now, what were the positions that I opened or issues that I had? Other than that, I was not going to open up any other positions, but I did. I opened up a position on Netflix. So Netflix came out with their earnings call. By the way, if you want to listen to their earnings call and my analysis, check out the channel for that. I think it's just like a 20-minute long video going to quite a bit of depth around the earnings call and their shareholder letter. So if you want to check that out, go to the channel. I sold a Netflix put credit spread below the market at around, I think it was 300 to 390, 300 to 290. Yes, that's exactly what it is. And the premium that I collected, meaning this is the maximum profit that I can receive on this, is $60. And I sold one contract. So the most I can get on that is $60. The most I can lose is $1,000. And I did this the day after I think it was, let's see, what day did I do this? I did this on Friday. Their earnings came out on Thursday or Wednesday afternoon, I believe it was. So the price continued to go down. So that position is currently negative $69. Now what that means is I sold that position, right? Like I had this pen, I sold this pen to you for $60, and now this pen is a lot more valuable because fucking red ink or whatever the fuck you want to talk about. The red ink is the only ink you can sign documents with now in the future by, you know, federal law or whatever you want to do. Talk about why the value of the pen is increased. Now, to give you an example of what that would be like is the value of this pen has gone up, right? Now, if I want to buy this pen back to close out this position, I have to pay $129 now. So I sold this to you for $60. My position is open. That's opening my position. Now to close out that position, I have to purchase this back from you. So when I go to purchase it from you, the value has increased. So instead of being $60 that we transacted at, now it's going to be $129. So I would lose $69 on that trade. And what causes that? Well, the price of, there's a bunch of factors that go into the pricing of options. The two of the biggest factors are the the price volatility of the underlying, as well as the volatility, the price level of the underlying plus the volatility of the underlying. Those are the two biggest factors that go into there. And Netflix has continued to drift down, which with a put credit spread, that in essence is saying that we want the price to stay the same or increase. Excuse me. So Tesla or Netflix is currently at 314, and this position is 300 to 290, which means that if Netflix this coming week comes down by another $14, then this is going to be a losing position more than likely. However, I did think that there might be a little bit more movement in Netflix, because sometimes it takes the market a while to digest what happens in an earnings call for some reason. And I think there's just when information comes out and gets disseminated from a company, there's some early adopters that use that information to trade. And then there's maybe some more thoughtful people who are like, take some time to really think about how that's going to affect the company, and then they potentially trade. And then there's the people who are not really paying attention, and they see the information several days later, and they do that. And that's my opinion. And this has continued the price decline. So that's how I figured that there would probably be some additional movement in Netflix share price. So I put out this, I sold this 2 weeks out. So the expiration on that contract is August 2nd. So if this next week it drops down to 300, and then the following week it goes back up to 320, I'll be good. Depending on what the news cycle is over the next 2 weeks roughly, I like to think that I can still make a profit on this position. The other two positions that I have open are the Tesla put credit spread below the market. It's 220 to 212.5. That's a put credit spread, and that expires on the 26th. So Tesla has their earnings call after the market, and they have a live Q&A that I should hopefully be able to listen into, and then come back with some good content on the 24th. So 2 days earlier. I believe that Tesla is going to beat on a lot of metrics, both from, we already know their deliveries are going to be higher than expected, but I think their revenue and their earnings, I think their solar business is going to have very positive momentum, and I'm bullish on their earnings relative to market expectations. So that's why I set that position up. Then also, so that expires 6/26. I took in $129 worth of premium, so the most I can make on this is about $260, $258. And then there's potential if Tesla goes from 257, which is currently at right now, and it goes up to 265 because it's been trending up as we get closer to the earnings call. So people are realizing like, yeah, they're probably going to beat their earnings. I might close that position out before Wednesday. Its current value is $64. That's for 2 contracts, right? So I got $129 per contract, and I have 2 contracts. That means the most I can make on this is $258. I've already made a little bit over $200. So instead of waiting till Friday to make the rest of this, if the price continues to go up and or some positive news comes out which causes that to happen, and I can close this out for maybe $15 per contract, then, which I probably won't, it would probably keep a lot of that premium in there until at least Wednesday. But if it continues to trend up, that could drop more of this premium, and it would allow me to close out this position and not even hold any of that potential risk that some weird anomaly happens with their earnings. The last position that I opened on Friday was the other position that was Amazon that I opened up on the 16th for $65 put credit spread. And I had 1 contract. I got $65, so that's the max profit. Amazon started moving against me. So on Thursday, if you go back and watch that video, I was losing $70 on that trade. On Friday, it actually took a positive swing and for part of the day, and jumped up, which allowed me to close out the position at $40, which means that, right, I sold you the pen for 65, and then I bought it back from you for 40. So I make the delta, which is $25. By the way, I use Robinhood as a trading platform. It's 100% free. you want, there's a link in the description. You get a free share of stock if you sign up. I also get a free share of stock, but you can do whatever the fuck you want. You don't need to use it. I just use it personally. So Amazon actually finished Friday at 1960. So this was a put credit spread on Amazon for 1960 to 1950, which means that if Amazon falls within 1960 or below, then I would be losing money on this. Not 1960. If it falls below 1960, I would be losing money potentially. And it finished at 1960 and 69 cents. So as soon as I saw that the price was moving up positively, like it would have expired at zero, but I didn't know that, right? So I closed it at $40, which still allowed me to make a profit on it. So it went from a negative $70 to a positive $20. So there was a big delta there over time. The last, position that I wanted to talk about is the Tesla 260 to 250 put credit spread. So there's a $10 swing on that, means a $1,000 loss is possible per contract. I have 2 contracts. The average premium I received on this, $555 times 2, $1,110 or something. And that's tremendous, because think about the swing, right? The delta on that is 260 to 250. So my break even is actually halfway through there, because I took in such juicy premium on this one. Tesla is currently trading at 257, and this doesn't expire until August 16th. And my original thinking was, several months ago when I put this on, is that more than likely their earnings call will be in the beginning of August. They actually are going to do their earnings early, which also indicates that it's probably going to be positive. Because if normally a company is going to do it like 5 to 6 weeks after the end of the quarter for their earnings release, I think they have, by law, I think they have up to 90 days. But if Tesla had been traditionally doing it 5 to 6 weeks out their earnings call, and now they're actually going to do it like 3.5, 4 weeks out,